I'm John Kambs. I'm the team lead at the Kambs Jennings group of Compass Mortgage, and really excited that you're here. Thanks for coming out or attending.
And I'm Caleb Jennings. I'm the best of the Kambs Jennings group. Just
The good
so
half.
I'm Caleb. I'm with the Kambs Jennings group as well, and I just wanted to thank you for coming. Sorry about the technical difficulties. It's been a little bumpy here. First time we had that experience, but of course, it's the first time we're actually doing this presentation with Tom, awesome realtor that we partner with, Tom Maczuga, Sweet Tom Chicago. So I just want to let you introduce yourself, Tom, and thank you for joining us today for this presentation. And sorry for the bumps on the road.
Oh yeah, very excited to be here. Thank you, John. Thank you, Caleb. My name is Tom Maczuga. I am a agent with Remax 10 based out of Lincoln Park, and I go by the easy to remember handle, Sweet Tom Chicago.
Awesome. So like Jessica said, if you have questions, we're going to do a whole Q&A towards the end of the presentation. So feel free to put them in the chat box as we go. And then we're going to get going here because we know you've been sitting for a minute. So we appreciate your patience. So John, let's do it. The 22 market forecast. You ready to go, bud? You're on mute, maybe?
I know. I'm on mute. Hey, everybody. Right. Okay, great. So yeah, 2022 forecast. As you'll see, some of the stuff is actually, the market has been very volatile as of late. There's a lot of things going on, and you'll see some of the stuff here actually changed since the presentation was made. But without further ado, so let's go ahead and look at the 2021 forecast or our recap here. So interest rates, what did we forecast? So last year we expected rates to rise beginning of the year and then recover into the fall. And what actually happened was rates did rise sharply through March as anticipated, but recovered a bit earlier than we expected, giving back most losses by late summer. I feel like I'm going to do something here. Make sure I'm not messing up the screen. Okay, so housing, strong demand for housing and tight supply would push home prices up by single unit digit percentage. And what actually happened, there was way stronger than anticipated demand and tight supply, but COVID caused supply chain disruptions and labor shortages, which pushed real estate values even higher than our robust forecast, double digit appreciations, as I'm sure most of you know. So
before we go into 2022 though, Tom, I want your reaction. You're a realtor. You were in the market in 2021. What were some takeaways that you have from 2021 as a realtor?
Yeah, well, from my point of view, it certainly was a whirlwind, and in an otherwise dismal year in many ways, real estate was definitely one of a few silver linings in the COVID pandemic. So how did it really play out? Well, we all saw unprecedented bidding wars and double-digit price growth. It was a very, very active market. Zillow coined the phrase the Great Reshuffle, and retrospectively, I think that fits quite well. And I mean that from a variety of perspectives. A couple noteworthy client trends. First-time home buyers were buying sooner than expected. Existing homeowners were upgrading or moving to the suburbs sooner than they planned, and sellers were trying to cash in. From a professional point of view, we as realtors, we had to shuffle around how we work. As a broker who represents both buyers and sellers, I observed there was a major difference in offer presentation. So working with sellers, I had to help my clients more carefully evaluate the best offer to accept. Sometimes it wasn't the highest dollar amount as you might assume. Working with buyers, I had to get extra creative and strategic. One notable tactic I leveraged was the Get Committed program that you guys offer, which without a doubt, I know there would be bidding wars I would have not been able to help my clients win. And lastly, I'll say that we had to, as realtors, take a significantly more active role in helping buyers define, prioritize, reprioritize their search criteria. So during this great reshuffle with work from home being the new normal, I think it was that much more important to help buyers understand their unique needs and non-negotiables. So was it accounting for a classroom in the house, a gym, an office, a swimming pool? And of course, all of this we had to do in a super fast-paced setting, fueled by incredible pants on fire urgency.
That's a good synopsis, Tom. And John, why don't you
Mouthful.
go ahead and take us to 2022? So
Sure.
walk us through it.
Okay, so here's 2022 and the dynamics that we're working with in today's market. So as I'm sure a lot of you have seen, is the Fed's going to play a major role in 2022. And the way they're going to do this is with tapering, rate hikes, balance sheet runoff, and this can impact stock markets, drive interest rates, impact housing as well as jobs. So some of the Fed voting members rotate each year, and 2022 composition will be less accommodative than 2021. And what that means is that the Fed's not, they really have inflation on their radar, and we'll go into this a little bit, but fighting inflation is going to be the main focus, and negative stock, but a negative stock reaction could cause the Fed to lose resolve. The composition of the Fed changing is pertinent because right now, last year there was more. There's basically hawks and doves is what they call them. A dove would be somebody who tends to have a less restrictive monetary policy, is more in favor of having lower interest rates to spur the economy, and a hawk is going to be somebody who's more conservative and would rather fight inflation. So the rotation of the Fed from last year to this year is more hawkish, not as accommodative as it was last year. So, but based on what we see here, is the Fed should have hiked sooner and mistakenly thought inflation was transitory. How many times have you heard that over the last year? And when you look from a historical standpoint, history can help us forecast how the Fed's actions in 2022 will influence the markets. So let's go ahead and do a really brief history here. So Arthur Burns, and this is basically the last a history of the Fed during inflationary times and what has played out and what has happened. So in 1970s, Arthur Burns was the Fed chair, and he basically ignored inflation, and it was rising rapidly at the time, and insisted inflation would be transitory. So he said the exact same thing in the 70s, and year over year inflation ballooned during his term from 7% to in 1978 to 14% by the time he left in 1980. So in 2 years, inflation doubled, and Burns remained steadfast that inflation was transient, and hyperinflation caused mortgage rates in this time period to go from 12 to 18%. So fast forward to Paul Volcker comes in after what was the other guy's name? I'm sorry, Burns, and he hiked the federal funds rate from 11 to 20% in 2 years, and inflation dropped from 14% to below 5%. So talk about a crazy 2 years or 4 years. So because inflation dropped, mortgage rates when Burns left and 2 years down the road after Volcker came in and increased the rate by 9% in 2 years, mortgage rates declined from 18% towards 12%. But there were consequences, and the main consequences was the S&P 500 sharply declined by 30% during this time, and the tighter monetary policy pushed us into a recession in 1982. So the next person that had to fight inflation or had a inflationary market was Alan Greenspan. And in the late 1990s, inflation doubled from 1.75 to 3.5%. Higher inflation caused mortgage rates to rise from 7 to 8.5%. But unlike Burns, Greenspan took action pretty immediately in mid-99. And he hiked the federal funds rate by 1.75. He basically said, hey, whatever the amount we have in inflation, I'm going to hike the Fed's funds rate, which is basically the overnight lending rate to banks. So in that time period, he raised the Fed funds rate from 4.75 to 6.5% in a year, and inflation responded and dropped from 3.5% towards 1%, and mortgage rates dropped from 8.5% to 5.5%. And this was when I got into the business and sparked a huge refi boom. But there were consequences, just like there were in the past. And the S&P 500 fell by 50% from spring to fall of 2000 and entered a recession in 2001. So today we have Jerome Powell. And 2021, inflation increased from 1.75% to 7%. And of course, as we've said, Powell thought this was transitory. Higher inflation caused mortgage rates to rise from 2.5% to 3.375%. So the Fed, in response to this, has been currently tapering their purchase of mortgage bonds and treasuries, and will not hike and reduce purchases at the same time. So the Fed basically has said that when the market, it was the shortest recession we had in history, but the recession that was spawned by COVID-19, the Fed came in and has been buying mortgage bonds and treasuries to drive interest rates down. And one of the misconceptions is that the Fed controls the market rates, and they don't control the market rates. They control the Fed funds rate, which is the overnight lending rate to banks. But they can definitely influence the market by becoming a buyer. So what they did is they came in and said, hey, we're going to buy mortgage bonds, we're going to buy our own treasuries, and this will drive interest rates down. So the Fed, with the recent rise in inflation, and then finally coming out and saying, oh, this isn't transitory, it looks like it's going to be here to stay, has said that they're going to stop buying mortgage bonds and treasuries, or tapering, so slowly reducing the amount that they buy every month. They've already said they're not going to do both at the same time, as far as like, oh, we're going to raise the Fed funds rate and stop buying treasuries and mortgage bonds. They figured it would be too dramatic for the market. But as you can see here, they're going to be done tapering in March, and they're going to likely begin hiking in May. And the Fed's targeting 3 rate hikes in 2022 and 2 or 3 more in 2023. Since this presentation has been made, consensus is now that they're going to hike 4 times. So as I said, this is ever changing and at the speed of light. So inflation and interest rates can rise still until the Fed starts acting. If the Fed can tame inflation, mortgage rates should drop, but they could potentially be dropping from higher levels. Okay, so let's take a recap here and see if we can see a pattern. So you got Burns and Volcker. Inflation goes from 7 to 14%, rates go from 12 to 18%, and they raise the Fed funds rate from 11 to 20% in response to that. Inflation goes from 14 to 5%, and mortgage rates go from 18 to 12%, and there's a recession. Okay, the next person to come in to fight inflation, Greenspan. Inflation goes from 1.75 to 3.5. Mortgage rates go from 7 to 8.5%. As you can see here, rates do not like inflation. Mortgage rates and really bonds don't like inflation. The reason being is that it's a fixed asset, it's a fixed return. So inflation can be used as expenses. So if you're an investor and your expenses go up, well, your profit margin goes down. So, and the only way to fight that inflation in the bond market or interest rates is for rates to go up. And that's what you see here. So the Fed funds rate under Greenspan, as we mentioned, he basically matched the increase in inflation with the Fed funds rate. So he said, okay, I'm going to increase it from 4.75 to 6.5 in that same time period. And as you can see, inflation went down. It went from 3.5% to 1%. And mortgage rates went from 8.5 to 5.5%. But again, huge recession. When I got into the business in 2001, it was the bubble, the .com bubble crash, if I remember correctly. And the S&P went down 50%. So now we have Jerome Powell, and inflation went from 1.75 to 7%. And mortgage rates in response to that have gone up by almost a full point, or 0.875. And again, as this presentation was made, now they're more 3.5, 3.75. So they've continued to rise. And the Fed funds rate is what they're hoping, what the consensus is that they're going to go from 0% to 1% in 2022. And the inflation should tame inflation, and mortgage rates should decline as inflation declines. And the stocks are already expensive, as we're going to show you in the next slide, and the economy is slowing. Signs have pointed that the economy is slowing and that we could be going into a recession. So talk a little bit about the wild cards we have here. Some of the wild cards, one of the wild cards is COVID, and COVID's playing a major influence on the monetary policy and supply chains. And a major surprise in COVID could just basically change this whole thing dramatically. As it appears, I think it's not, but who knows? Additional stimulus, if COVID rears its ugly head and then turns in that we have to do more stimulus packages to help our public, well, that could fan flames of inflation, and this would push stock prices temporarily higher. This could cause mortgage rates to rise further and make the Fed's job of corralling inflation even more difficult. And the other big thing is the runoff of the Fed's balance sheet. So first step Fed's going to do is stop buying new mortgage bonds and treasuries. Next step is that they're going to hike the Fed funds rate to tame inflation. The Fed is still buying $7 billion a month of mortgage bonds through reinvestments to keep rates low. And what that means is that the Fed has kind of done a two-pronged approach. They said they're going to buy new mortgage bonds to drive interest rates lower. But as the Fed has driven interest rates lower, it's had a huge refi boom. And so the Fed basically has committed that any of the refinances, because if the Fed buys $1 billion in mortgage bonds and then drives rates down, well, a very high percentage of those mortgage bonds ends up getting refinanced because the rates are so much lower. So the Fed basically, their two-pronged approach was to say, hey, we're going to take the money from the refinance activity that we got and just throw it back into the mortgage bond and reinvest it in mortgage bonds to keep driving interest rates down. So if and when the Fed stops reinvestments, mortgage rates could move higher than previously thought. So one other big wild card here, we know they're going to stop buying new mortgage bonds and treasuries. We know that they're going to raise rates, but their reinvestments is kind of they haven't really been forthcoming as to what they're going to do with that, and them removing those it's going to really be dictated on what happens with inflation, but it could push interest rates even higher. And stock market forecast, stocks are expensive and price to earnings multiples are high. So this is basically 15 different indices or indices that indicate whether or not stocks are overvalued. And as you can see, all of them basically are saying the stock market is extremely overvalued. So rate hikes is going to have a negative impact on the stock market. And we're basically, and you can see, I think the S&P 500 is, I'm sorry, not the NASDAQ has down, I think already 12% this year. So stocks have been taking it on the chin because they know that the Fed's going to start raising rates. And we're forecasting a 10% decline in the major stock indices this year. So the million-dollar question, what is going to happen with interest rates? Well, we anticipate mortgage rates to rise along with inflation during the first part of the year towards 3.75. And again, we're a little outdated here because they're pretty much here. It's how fast this has been happening. With Fed action, softer stock market, slowing economic condition, rates could head lower in the second part of the year towards 3%. So Fed's going to start in March. They're not buying any more new mortgage bonds, and then at the end of they're going to start increasing rates. So as they do this and the stock market suffers, we do expect rates to come back down in the second half of the year back towards 3% as the Fed hikes rates. Strategically, this sets up a bias for your clients for less upfront fees because of a refinance opportunity ahead. So always good to have somebody like us that can really go over this with your clients and say, hey, instead of you paying egregious fees and points to lower your interest rate, it may make more sense for you to do the opposite and take a higher rate and get all of your fees paid for, because in 6 months you may be refinancing and you'll never break even on the cost. So housing forecast. We're predicting housing to remain strong into 2022, but not as strong as 2021. Demand will be slightly softer due to a rise in interest rates, but still robust. Supply will increase but remain tight, and that's obviously going to be tight labor, supply chain disruptions, and semiconductor shortages will play a role. And rents will continue to rise. Increase will remain above 5%, pushing many people to see the benefit of buying. So we're forecasting mid to high single-digit appreciation. still providing a great wealth creation opportunity. And as all of you know, with rents increasing as dramatically as they are, buying even during the Great Recession or the big mortgage meltdown, arguably from a long-term perspective, buying always makes sense. So I think we were going to have Tom come in here, if I'm not mistaken, Caleb.
Yeah, no, I wanted Tom, just after this forecast, I think it'd be great to have your perspective as a realtor, how you advise your colleagues, fellow realtors, to advise their clients in this market. Like, what do you think, and how would you best do that?
Yeah, thanks. I think that John just shared with us a lot of really great information, and I think that it's going to be really important for us to find ways to really digest it and then deliver it back to our clients in a way that is practical. So I think we're all going to experience some trepidation from buyers, especially first-time buyers. We're probably going to hear that rates are too high, I want to wait for them to drop, or prices are too high, I can't afford a home, or I can't find a home, or perhaps there's too much uncertainty, I worry that we're in another housing bubble. So to that end, I think it's more important that we leverage as real estate professionals the resources we have at our disposal to guide or advise our clients appropriately and effectively. So yes, rates may be higher, but not only are they still good, but we ought to point out data shows that you shouldn't look at rent as a form of relief. Not only is rent projected to increase, but it's actually estimated to outpace that of home prices. A economist at realtor.com, Danielle Hale, she crunched some serious Chicago numbers recently and calculated that buying a starter home in Chicago, believe it or not, is 50% less expensive per month than renting. So yes, prices are going up, but all prices are going up. John talked a lot about inflation. So who here hasn't recently done a double take at the fuel pump or at the grocery store looking at a receipt? And while prices are going up, so is inventory. So I think we need to explain that inventory is starting to increase, and we can therefore help you find your heart's desire. First-time home buyers, especially, I think they're likely to see affordability issues, but Chicago is an incredibly large and beautiful city. And I say, let's tell our clients, let's explore it. I hear people say there's nothing west of Western, and nothing drives me more mad. Yes, there is. I mean, have you not heard of Logan Square? Take a field trip, explore our city. And I really like following what Dr. Lawrence Yun often reports on the market and the economy. He is the chief economist at NAR, and he points out that real estate continuously proves to be a good inflation hedge over time. Home prices keep outpacing consumer price inflation. So real estate is an appreciating asset and also an opportunity to lock in your payment. And then in regards to another crash, if as a realtor you hear your buyers being nervous about that, there is so much evidence that shows we are not in another housing bubble. In fact, John and Caleb, the Kambs Jennings group, you guys did a separate presentation on just that. So I say to my colleagues, have your lenders, have John and Caleb do the math for your clients to show the difference in monthly rent versus monthly mortgage payments. And while doing all of this, An important strategy, I think, is to make sure you and your clients work with their lenders to rate proof their budget. So, what will pity look like if the interest rate is X or Y? Make sure your clients are prepared. Lastly, I'd say to your clients, don't let last year's stories or fear-mongering news or your friends' stories drive your decision or motivation. Every situation is unique, and last year's buyers who wanted to buy, they really bought whatever, new construction, old construction, condos, townhouses, they didn't care. In many ways, it was just madness. Is there a time sensitive component to buying today in 2022? Yes. Is it pants on fire hot? Maybe not. Either way, every single situation is unique. Help your clients navigate this. We have to remember that we're real estate advisors and guides who help manage and build generational wealth, and as guides, we can't do this alone. It's a journey that requires a lot of subject matter experts, attorneys, inspectors, and of course, great lenders such as the Kambs Jennings Group of Compass Mortgage.
Awesome. Thank you,
Thanks,
Tom.
Tom.
And one thing too, just again, we're the Kambs Jennings Group of Compass Mortgage. We underwrite our loans in-house. We fund our loans. We close on time, and we give your client an amazing experience. So before we move on to questions, is there anything else to add, John or Tom? And then we'll open it up to the folks for questions in the chat room.
Yeah, I was going to say, if you guys want a copy of this presentation, just let us know. It's actually easy to edit. So if you wanted to get your name and number on it, it's really simple. We use this with clients all the time. I think that when I got into the business, I used to think clients don't want to hear this stuff. And I think that's somewhat true, but I think that what clients tend to do is when you can talk about this stuff, the question is, well, what else does John know that I'm not going to know? So let us know if you need a copy of the presentation. We can get that to you. Just shoot us a text or an email.
Awesome. So Jess, aka Brian, you're on mute, I believe.
Yes, can you all hear me okay?
Yeah, we can hear you. So yeah,
Okay,
we can
great.
open up the floor for any questions that have come in, and then you can help us with them.
Again, great presentation, you guys. Thanks all for sticking with us here through some technical difficulties. I said this didn't happen in the practice, but why does it have to happen live? But that's the way it rolls sometimes. So we have a couple questions rolling in. The first one here, Justin, thanks for your lengthy thought here in the chat box. That's great. So I'm just going to kind of pick out for the guys here so they can answer your main question here. So in essentially inflation, the history of inflation shows a much higher increase in mortgage rates. And so he's essentially wondering, how are we seeing more of the mortgage rates staying in the 3s as opposed to, maybe going into the 7s?
Yeah, I can answer that question. And it would be because the Fed has basically been buying mortgage bonds specifically to drive them down, or to drive the rates down. In the past, the Fed was not nearly as accommodative towards mortgage interest rates. So you have basically the Fed buying a huge amount of mortgage bonds, which in the past they never did. So that would be the reason.
Okay. Great, thank you. Justin, hope that helps there. If you'd want to write in any more, just go ahead and let us know. Let's see, any idea or indication on when the Fed could gain more control over inflation?
Yeah, this year, if you look, like the Fed, over the way I've seen this is that after the Great Depression and after the Fed has really they've been learning how to do this over years, and they know that they can control inflation by raising the Fed funds rate and stopping and letting a free market happen is really. But when you let a free market happen, there's going to be pain. And as you see, if the Fed were to basically say, hey, we're going to jack interest rates up and stop buying mortgage bonds, we go into a big recession. So what the Fed's main role is to really, they want the economy to be healthy, but they don't want it to be too healthy. And when the economy is too hot, that's when you get inflation. And their monetary policy has really, in the stimulus packages, has really fanned the flames of this. So I think that it's not a question of what the Fed can do. They know what they can do. They have to do it. And like the slide presentation said, are they going to lose resolve? It's very easy to say, oh, let's tame inflation, but then when the stock market takes it on the chin, and all of a sudden people's investments are worth 50% less, then all of a sudden nobody wants to be conservative anymore. Everybody wants to be, let's go back to the way it was. So it's going to have to be a good balance of raising interest rates and not losing resolve, but also not raising them to the point where it has a dramatic effect that is too painful. I think a good metaphor is like when you, and this is how the Fed kind of reacts, is that it's when you turn the hot water on up in the shower, you don't really realize how hot it's going to be when you first turn the dial. You could 2 minutes later be scalding yourself, and then you have to turn it down. So that's kind of how these policies work. But I would say that the way they're going to do it is what they've already done, and you've seen it. Rates start to. That's why you've seen mortgage rates start to react, is because they know that as the Fed raises, as inflation gets hot, the Fed hasn't really done anything other than stop the taper or stop buying mortgage bonds, which is making them go up because they're not the amount that's being bought. The artificial market that they've created is evaporating. But as they raise the actual Fed funds rate, you're going to start to see inflation tame. So, I know it's a long-winded answer, but that's how it works. So.
That's okay. We'll take it. Let's see. So with the forecast of, let's see. So taking into consideration that all situations can be different, and the forecast of rates potentially lower in the second half of the year, does it make sense for anyone to potentially hold off until that time frame from a purchase?
I'll start. I'll say no, just because as a consumer, sorry, Kill, but as a consumer, you get to just refinance. So if you were to buy today and say, oh, I've got 3.5%, but John was right, rates are 2.75 at the end of the year. Well, guess what? We'll be calling you and refinancing. So you get to win either way. But if the opposite happens and we were wrong, then you could be saying, well, I could have gotten 3.5 at the beginning of 2022, but I waited and now rates are 5%. So I would say no, the cost of waiting is always typically from a long-term investment standpoint, way more expensive than trying to time the market.
Yeah, and I would just on that too, just if they're renting now too, and then they're thinking they're going to sit it out. One thing I can guarantee is their rent is going to continue to go up. That's an absolute as well.
And
Tom, you're nodding your head. Do you see this a lot?
One thing that I wanted to just add to that is, even though the rates are increasing slightly, they are still good. And I think we need to keep emphasizing that. And we're not going to see rates in the 2s again. And that's actually a good thing. That means the economy from a greater perspective is starting to improve. And it is not something that, we don't really, in the greater scheme of life, want our rates in the 2s anymore. If you think about it, that was a result of COVID. It was a result of a big, global problem. So don't be afraid because they're increasing a tiny bit. And remember that as a tangible good, excuse you, Cedar, buying is a very reliable investment in the long term.
Yeah, and I just think too, there's a lot of folks who were sitting on the fence when rates were at historic lows, saying costs are home values are too much. I'm going to sit out and wait because they're going to come down. Well, they haven't come down. So a lot of the folks who sit on the fence thinking that they're going to predict the perfect time end up really losing out. So at the end of the day, you got to ask yourself, do you need a home to live in? And do you plan on living there for 5 to 10 years? Then I would say, yeah, you should buy.
Yeah, and piggybacking off of that, Caleb, I mean, not only has values not gone down, but rates have gone up pretty high. So your buying power has waiting. You've really shot yourself in the foot if you did wait in anticipation of prices falling. Again, nobody can time the market. A lot of people have tried, and nobody has consistently timed the market. So don't fool yourself into thinking that we can or that you can.
Okay. John, you kind of touched on this a little bit, but in terms of refinance, if someone does purchase, you know, in the next couple of months, what is the refi period? Is there a certain amount of time you have to wait?
No, so there is none. There's no prepayment penalty, so you can buy a home today, close a mortgage, and win the lotto on Friday and pay it off. So there is no. A lot of places will lie to you and tell you that because they don't want to. Most places, what they call an early payoff. If they refinance a mortgage before 6 months of the funding date, then they'll have to pay the investor back. But you as a buyer, that doesn't affect you. So you could get 3.5 today, and then 2 months down the road, if rates are 3%, or I'm sorry, a lot lower, you can refinance. There is no wait time. You can refinance at any time for conventional loans. And I've been doing this long enough to where back when there were prepayment penalties. But from what I see here, there's really no prepayment penalties. So no, you can refinance the next day, and that's a good example would be is if that's what I was saying at the end of the presentation, is not paying a lot in fees, because today you'd probably have to pay a full % of the loan amount to lower the interest rate by 1/4 of a point, and that's usually going to take you 5-6 years to break even on that expense. So odds are much greater that the rates could go down, you could sell before you ever break even. So contact us, we'll give you an analysis, but no, you can refinance at any moment after you get a mortgage.
I just want to actually add just one more consideration there too, as we're, thinking about interest rates. A lot of people are getting hung up on the difference between what somebody had last year, be it 3.5, and now they see us inching closer to 4. You have to remember the people who maybe secured a slightly lower interest rate last year, their inventory, the options that they had to work with when they were buying, they were much smaller. Like buyers could not find what they wanted. Inventory is still going to continue to be challenging, especially for first-time home buyers with some affordability issues. But now you're starting to see buyers have an opportunity to have more to pick from. So it's important to also seize that opportunity.
That's right.
Cool. Looks like one last question here, and then I'll give you guys the floor for any final thoughts, comments. Do you have any rent versus buy information or tools that you could share? I guess that's probably one that y'all could speak to.
Absolutely. Yeah, no, we've actually done a presentation on this, as well as we've got tools. What I would suggest is just hit us up, email the kjg@compmort.com. We're happy to help your clients with that. We could teach you how to do it as well. So just hit us up, and we would love to schedule some time with you to help you use that as a tool to educate your clients.
And we do have, to answer the question more clearly, we have a very amazing rent versus own that's really, you can't get anywhere else, that really breaks down everything like that. The canned rent versus own that you see is typically like, it has maybe 1/3 of the information that ours has. So just hit us up. We can do it for you. We can show you, we can present it to you so that you can go and then present it to the client if you wanted, or you could, we could present it to the client with you, whatever works best for you.
And I would
Okay.
challenge buyers who are thinking about potentially maybe renewing their lease. And I would never, force a customer to buy. If it's not the right decision for them, they shouldn't buy if they don't want to buy. There's no point in trying to force a shoe. But if they are in a position to buy, as a realtor, I would tell another realtor to ask those clients, what are you going to do with that extra money? What are you going to do with that income? What are you going to invest it in? Are you going to gamble with it and put it in crypto? Really, honestly, like take a step back and ask yourselves, what is it that you're waiting for? Is it that maybe you might be moving in 5 years to a different state? Okay, sure. So maybe buying right now doesn't make sense because there is the potential of relocation and you might not make back that initial investment, because we all know buying in real estate is a long-term investment. But if you know you're staying here and you have good job security and the credit score and the income to allow for it, why not build that wealth? What else are you going to do with that money? Why are you going to put money in someone else's wallet?
Awesome. I think that's a great note to end on. Any other
All right.
questions? We good?
No, I don't have anything else rolling in right now. But I know you all shared your contact information, Tom and KJG, on the last slide there. Oh, go ahead.
So no, just we want to thank Tom for joining us. This is the first time that
Yeah,
we've
thank you, Tom.
had. Tom's one of our realtor partners that we do a lot of business with, and we love working with Tom. And it was great to have this conversation with you today, Tom. So thanks for joining us.
I thank you. I love working with the Kambs Jennings group. You guys are fantastic lenders, true subject matter experts, and I appreciate everything that you do. My clients appreciate everything that you do.
Thank you.
Thanks, Tom.
Awesome.
All right.
Thanks,
closing,
Brian.
Bye.
thank you. Yeah.
Bye, everyone.
Thank you.
Thank you.
Everyone have a great afternoon. Thanks so much.